Welcome to the best of Bloomberg Invest 2023. I'm Sonali Basak. The hunt for opportunity is a daunting challenge given fears about a recession and historic volatility. Bloomberg's annual Invest conference brought together the biggest names in finance, economics, and investing to discuss strategies around those challenges. Those discussions focused on three main themes: debates over hard, soft, or no landing, the next investment opportunities, and the promise of AI. But let's start with where the markets are now and whether the Fed has control over this economy. I spoke with legendary investor and noted bear Stanley Druckenmiller about that and more.
There's a 500-year history of asset bubbles, well documented in a book that you had some issues with, The Price of Time. And basically, it documents, and I had already known this about the last 100 years, but it's going on for 500 years. Every time you've had a significant asset bubble, economic trouble lay ahead. But yeah, when you had 11 years of free money, people do stupid things. All you have to do is look it up there. But the stupidest is somebody paid $80 billion for Dogecoin, which was invented as a joke. I mean, that can only happen in the world of free money. It also suppressed people worrying about the kind of stuff I just talked about 2 or 3 minutes ago because you keep rates at zero. But the fact that this was arguably the most disruptive economic period we've had since the late 1800s, and there were no bankruptcies, apparently they've started in the last few weeks, tells me there's a lot of stuff under the hood when you go from this kind of environment, the biggest, broadest asset bubble ever, and then you jack rates up 500 basis points in a year. I think the probabilities would suggest that Silicon Valley banks, Bed Bath & Beyond, they're probably the tip of the iceberg. Nothing's a guarantee. I've been wrong a lot. I've been right a few times. But our central case is there's more shoes to drop, particularly in addition to the asset markets economically.
What are you most worried about? We'll definitely get to the opportunities and the fat pitches that you see on the horizon. But before we even get there, what starts to sink?
I could see corporate profits down 20 to 30%. Normally, I would say 40 or 50 in a hard landing. But this recession is so anticipated. I don't think a lot of corporations are going to be caught with their pants down, which is how normally you lose a lot of money, is you're not prepared for something that happens. Commercial real estate, I'm not informing anybody in this room of something I don't know, but office is a problem. It would have been a problem anyway, but change of lifestyle and COVID makes it an even bigger problem. Financing rates going up make it a problem. I'm worried about credit tightening the next 6 to 9 months. Obviously, the banks are going into an economic period that if, in fact, we get a recession, their balance sheets are already impaired, not from where they usually lose money, which is loans, from the fact that the Fed convinced them that they're going to keep rates to zero until 24. So they bought a bunch of treasuries yielding 1 or 2%, and now they're carrying them at 5%. So their balance sheets are impaired. But if we get in a recession, then the real losses comes, which is stuff like credit cards, commercial real estate, that kind of stuff. So those would be my worries.
You just think about the everyday needs of people, how they are filling up their gas tank, the price of food, the cost of clothes, whatever that is, that impacts their overall financial picture. And so when you hear stubborn inflation is still high, we're already seeing the impact on the average consumer. To have people go into their retirement plan and reduce their contribution because they're making an impossible trade-off is a concern. And when you think about what does that mean, that means they're taking income that they're going to get taxed on. So that dollar is not a full dollar. And they're losing the compounding value over decades. So the real question for us is when people are making those tough choices today, specifically in a high inflationary environment, how do we make sure that as we're navigating through this cycle, that they can get back on track? So it's not just about the here and the now and the decision that an average American is making today. It is also about what do we do to help that average American get back on track to make sure that they can make better investment choices through the long term in order to make sure that they can have a secure retirement.
Look back at 2021, say July 2021. you had high yield, IPOs, and private credit, or credit, not private credit, at about 8.5% of GDP. Today, April, was about 1.3% of GDP. So what's happened is you have a much tighter, capital market. That just makes it tougher to do deals. Having said that, the private credit market is very strong right now, and people like KKR and others that have a large private credit business, we're able to fill the gap and do things. Secondly, we bought several companies that we just did all equity, and we'll finance later when rates come down, and we've got plenty of equity capital. We'll buy them with just equity. And so what you're going to see, I think, is a sustained period of time where the capital markets will stay tighter. It is not, to date, a credit issue. Could become a credit issue, but it's not there yet. It's more of a liquidity issue right now as to why you're not seeing as many private equity deals done.
We are at the beginning of a very classic late big cycle debt crisis, when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers. What's happening now, as we have to sell all this debt, is we then do have enough buyers. There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions, and then there's this geopolitical shift. So when I look at the supply-demand issue, there's a supply-demand issue for that debt. There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult.
I think that people have been cautious for a long time. It kind of comes out of the COVID mindset, and you could see a lot of fear in the market. We had Ukraine, we have inflation, we have all sorts of senior loan officers starting to slow down on lending, and you can kind of see these problems. But at the same time, then you see this jobs number, and it's very strong, and you see signs of life. And so I think people are tired of being defensively positioned, and probably have felt some temptation, especially with this AI boom, to say, look, maybe we have to move out of T-bills back into risk. And I think T-bills are so attractive, because wouldn't it be beautiful to stay conservatively invested if you had to be long, with that dry powder, if you're not in a tail fund, to sell those T-bills and move in when there has been a real reckoning. I feel like the market is tired of being bearish, and so to have now, looking at just the front month VIX, for example, the fear gauge, to have that now at its lowest point since a month into COVID, or sorry, 6 months into COVID. So almost 3 years now, the lowest point seems kind of wild when you think about all the uncertainty that's in the market. And so I think this is a time to be cautious, because the pricing, leaving aside some AI stuff that can keep going, the pricing is not there, and we should continue to be cautious, even if that's a little bit boring.
If you want to paint a more cautious picture, you would say we might have a mini stagflationary scenario. It might not be massive stagflation, but if you have sluggish growth, 1% plus minus growth, and inflation doesn't really get down below 3%, and rates have to stay 3+% for a while, that's not going to feel, it's not going to be called a recession, but it's not going to feel great, and activity levels will be more challenged. That's the scenario we kind of plan for and worry about, because that's a scenario that could persist for a while, where you just get sluggish growth. I think we need better growth. We need more productivity. And there are impulses that could provide that. I think, I'm sure you'll want to talk about AI. Generative AI is a potential positive productivity boom. I think a lot of what's going on in science, life sciences, and the investment and the progress that's being made, there's plenty of innovation that we could point to and say there's an enormous opportunity to have like another industrial revolution that just might be more of a digital revolution and a science revolution, that could unleash a lot of productivity, but we need something to get more growth in the economy that will allow us to deal with some of the challenges we're going to face.
Coming up, artificial intelligence and what it means for the future of investing. This is Bloomberg. Ever since OpenAI rolled out ChatGPT in late 2022, the world has become transfixed with what AI can do. The same is true for investors. Everyone who spoke during the Bloomberg Invest conference had something to say about AI, including NASDAQ CEO Adena Friedman.
We have been leveraging AI within NASDAQ. Verafin has been using it for several years. And there it's really kind of advanced algorithms, self-learning algorithms, getting smarter and smarter and identifying patterns of behavior. And so we're able to learn from them as to how they've been able to integrate that into their product suite and into their product development suite to make it so it's more effective. At NASDAQ, we actually are asking the SEC to approve our first AI-driven order type within NASDAQ. And a big part of that is we have billions and billions of messages that flow through our systems every day. About anywhere from, I would say, 60 to 80 billion messages a day. So we have a big data pool. And what we're trying to do is structure order types that give institutional investors better fill rates. So we have a certain kind of order type called a midpoint extended life order, a little technical, but there's a timer on the order. It actually introduces latency to create a pool of liquidity that's kind of segmented within the market. And what we're trying to do is see what is the optimal timer on that order that maximizes the fill rate at the stock by stock level. And we evaluate about 175 different characteristics of the market to try to identify what is the right timer, each stock by stock, and it updates every 30 seconds.
AI has been having an impact for decades. And this stuff isn't brand new. The applications that you're seeing today have been in the works for quite some time, and in various applications, you've been interacting with essentially language models. You've been interacting with deep learning. You've been interacting with all sorts of AI approaches. So what's really changed is that the awareness has occurred. There have been some recent advances that have been created by scale-ups, creating ever larger models, which have displayed properties and behaviors that are very interesting, unexpected in some cases. I think everyone in the research world, everyone is pretty surprised at the behaviors that are emerging from large language models. That's actually really, really interesting. Some people have claimed it's sentient. And then when they say that, they get into trouble. I certainly don't think that it's sentient. But I could talk a lot about this, but I'll pause. But the one thing that I wanted to, it's almost like a joke. When I was at the AI lab at MIT, back in the 80s, late 80s, the joke was whenever AI, the definition of AI that we used was something that you could not achieve in a computer. So anytime that you actually got a program to do it, and everyone would say, that's not AI, it's just a piece of software. And so that actually, it's not really a joke. When I look at many of these things today, I say, okay, it's really cool, it's unbelievably impressive, it's very useful, but this has just been a progression. You could say that about computers in general.
It's just more software. That's how I would see it.
Just
and
more
we've been
software.
bringing more software into finance for a really long time. And there's been all kinds of breakthroughs, and there's been all kinds of problems. It is statistical pattern matching. It's extremely powerful, and it's interesting. But I do not see AI achieving what some would call the Holy Grail. Everybody wants to know, what's the S&P going to be in 6 months?
Can you tell me?
And I can't.
Okay.
And neither can the AIs. And at the risk of getting too technical, there's a really profound technical reason why the AIs, I think, are not going to do that, predict the stock market. The successes that we've seen in AI, and they are amazing, they are brilliant, all come from one profound realization, which is if you can take a large number of samples and you can dichotomize it and say, these are pictures of cats and these are not pictures of cats. And it turns out the internet was great for that because people love putting pictures of their cats on the internet, and they say, this is my cat. So now you've got this labeled data set. Well, we've gone to town on that. You can train up an AI, and it can say, you give it a new image it hasn't seen before, and it'll tell you whether there's a cat or not, and then it'll tell you all the variations. It will tell you, this cat is 10 years old, and it's this breed, and it might be sick with this kind of disease. It's just gotten better and better at that. But that is because the concept of a cat is stable in time.
Cats aren't evolving.
Well, they evolve, but very slowly in evolutionary time, not from today to tomorrow. The stock market is notoriously not a stable distribution.
A lot of these bots or autonomous agents in the AI sphere, they're going to need to go get things done in the world, right? People are already using them to sort of say, hey, order my groceries, or maybe build this website and spin up this server. And so they're going to need financial money. They're going to need money to go do things in the world, these AI agents. And so I think that actually in the future, you're probably going to see a lot of crypto transactions happening between AI agents or AI and various businesses around the world, because crypto is kind of the native money of the internet. The internet is global, it's decentralized, every country, everybody in the world can participate in it. And so it wouldn't really make sense to use the dollar or the euro in a truly global context if you want to be country agnostic. So I think AI will use crypto more.
It is clear that we're at the beginning of a mega cycle in spending in AI. And the real beneficiaries, obviously, are the applications, so your SaaS companies, and infrastructure, so it's cloud and your high-performing chip companies. Those stocks right now are extrapolating pretty enormous compounding growth. We wouldn't necessarily chase that, but to your point, what's really striking about where we are right now is AI allows us to talk to computers like ourselves, and the ability to tap into massive compute power, and probably even more importantly, enterprise data and just global data generally is going to be seismic, and the capabilities are just going to be exponential.
Coming up, how are Nuveen, Citigroup, and Ares competing for the next generation of wealth? Welcome back to the best of Bloomberg Invest 2023. I'm Sonali Basak. As millennials and Gen Z come of age, they are investing differently than their parents are. Nuveen CIO Sarah Malik, Citi Private Wealth Global Head Ida Liu, and Ares Global Head of Wealth Management Raj Danda spoke on how financial institutions are pursuing the next generation of wealth builders.
Over the next number of years, we're going to see one of the largest wealth transfers from wealth builders to wealth inheritors. Trillions of dollars are going to change hands. This has a lot to do with how financial advisors are thinking about helping people manage their money. Two areas that are important are building bonds early and trust. So our surveys show that wealth inheritors will stick with a financial advisor if they feel like they trust them. And then for financial advisors, it has to do with building bonds early with those wealth inheritors. Our studies also show that if a FA gets to know a wealth inheritor when they're in their teen years, there's about an 85% chance that inheritor will stick with the FA. And if a financial advisor gets to know them as an adult or young adult, that percentage of keeping that FA drops to about half.
The investment solutions that are available today in the private markets have really changed the landscape. You have opportunities to build a core allocation through open-ended strategies. You can be opportunistic through some of the traditional drawdown funds. And all of that actually really helps the next generation have a lasting, durable allocation to the private markets, which wasn't really possible in the prior generations when the lack of alternatives in the private markets led you to focus principally on a stock and bond allocation.
I believe in the future that we're not going to be talking about ESG or impact investing as a separate class. It's not going to be a separate product. It's just going to be part of the core portfolio. Because the conversations that we're having with our investors around the world, particularly pronounced with the women clients and with the next gen clients and millennial clients is they care deeply about doing good with the investment dollars. And the important fact is that they don't have to give up or compromise on returns to do good.
If somebody says this is generational, are you talking about what? Finance. It means that you're glorifying ignorance. Okay, you can't glorify ignorance with random events, with processes. Where to the contrary, you got to glorify experience. So that cult of the youth that we have today, of course, is getting busted in finance, and soon the kids will no longer be interested in crypto. They'll be interested in some vegetarian diets or something else.
One future opportunity that several Bloomberg Invest speakers have agreed on is that women's sports has room to grow, and there's plenty of reason to believe that it will.
I think women's sports overall, huge momentum. We're going to get a huge lift off the Women's World Cup soccer this year. We're going to get a huge lift off the Olympics next year. The USA women's national team is going for their 8th consecutive gold medal there in Paris next year. It will be an all-time record in the history of team sports in the Olympics. And guess what? None of you probably know about it, right? Yeah, we have to market around this. We have to capitalize on it. But I think there's never been a better time to invest in this growth story. We are a sports, media, and entertainment property that is growing.
Sometimes when an offer is given to us, we're just so grateful that an offer is given to us, that even if they give us a bare minimum, we're like, oh, great, someone wants to talk to me kind of mentality, and that needs to change. We need to look at what is given to the men. We need to look at what is the fair price for it and fight for what we're worth, and also ask the question of, is there an equity play? Can I take ownership in it? And I think just a change in that mentality with younger athletes will go a long way.
So I think the next big opportunity is in women's sports, right? Why? Because more and more people, if you see the women's NCAA tournament, you had more people watching that, right? NCAA women's final, the tickets went for more than the men's final, right? So you didn't know that, did you? All right. The haters will say that's because there was only 20,000 seats in the women's, whereas the men had 60,000. But at the end of the day, those seats, people were paying more. And when I look at that, I sort of see that over the next, here's another question, right? And you guys, you'll just prove all my points, hopefully, since I don't know the answers, and I hope you're going to do it the way I ask. So right now, I think it's like 95% of all sports on TV is when you're watching it, it's male sports, right? It's football, basketball. All right. Do you think over the next 5 years that number goes up or down? Right, it's going to go down. It should go down. You're going to have more women's sports. You're going to have different things. So if you believe that, that means you're going to have more media rights for women's sports. And if you have more media rights, then the value of those franchises will go up. So I think today you can get involved in women's soccer. You can get involved in basketball. You can get involved in all these different sports. If you look at kids, they want to see other women play. Mm-hmm. So you're seeing that there's this tremendous amount of demand, and it'll sooner or later take over from the media rights.
That's all for the best of Bloomberg Invest. You can watch full interviews at Bloomberg.com and on the terminal. I'm Sonali Basak, and this is Bloomberg.